See this? This is your long option contract. And this could be your option after a volatility crush. Worthless. Buzzer beaters aside, let's break down what volatility crush is. But before we dive into it, make sure to like and subscribe for more trading tips. Volatility is a measure of the amount an underlying asset, like a stock, is expected to fluctuate in a period of time, with historical volatility measuring past movements and implied volatility, or IV, for speculated future movements. IV will often spike when the market expects big movements in any direction. Think upcoming earnings announcements or interest rate meetings. These can often drive IV up, which then falls towards historical levels after the announcement is made. And because IV is one of the contributing factors to option pricing, all things being equal, a higher IV means higher option prices. For example, let's say you thought a stock would go up around $5 because of an earnings announcement this week. So, you buy a slightly out-of-the-money call option for $4.10 that has 4 days to expiration and expires after earnings. The earnings announcement happens and the stock price jumps up $4 overnight. But now that the announcement has been made, there's more certainty about the stock price between now and expiration, so IV falls towards historical levels. Now, your option is only worth $1.52, even though the stock went up. This is called volatility crush, and it can have a major impact on option prices. So, if volatility crush is a disadvantage for option buyers, how could a trader try to take advantage of it? One way traders can try to take advantage of volatility crush is calendar spreads. They sell an option that expires soon, called the front month, and buy an option with the same strike for a later expiration date, called the back month. The trade results in a net debit, which is the maximum risk for the trade. The hope is that after earnings, the stock price is close to the strike price traded, and the volatility crush causes the front month to lose as much value as possible, while the back month retains as much value as possible. This should result in being able to sell the spread for a credit that's larger than the initial debit. Here are some things to consider when looking to implement this strategy. The strike price you choose should be based on where you think the stock will be after earnings. This gives you the best chance at maximizing your potential profit. The option being sold expires on the earliest date after earnings to benefit the most from the volatility crush. The long leg should have an IV that's not as inflated by earnings, but keep in mind that the farther the expiration date, the more expensive the option. And since this strategy is a debit spread, the more the trade costs, the more your maximum risk is. Since you're trading multiple contracts and likely not holding them to expiration, you want to be able to trade in and out of these spreads efficiently, so look for options with liquidity. Lastly, trading in and out of spread trades can rack up commissions quickly, so factor these costs into your decision-making process. So, for next earnings season, you might want to get a real ball if you want to break that record, because now you can flip the script on volatility and crush it. Are you trading implied volatility in other ways? Let us know in the comments below.